Section 4:2 Introduction to Beta. Beta adjustments. Beta adjustments are necessary in certain situations to account for factors that can influence an investment's risk profile beyond its inherent systematic risk. Here are some situations where beta adjustments may be required. Non-representative time periods. If the historical data used to calculate beta does not adequately capture the current or future market conditions, adjustments may be necessary. For example, if the available data is outdated or covers a period with unique market characteristics, such as a significant market downturn or an extended bull market, the calculated beta may not accurately reflect the investment's risk in the current environment. Adjusting beta estimates by incorporating more recent data or considering alternative estimation periods can help align the risk measure with the current market dynamics. Changes in business or market conditions, significant changes in a company's business model, industry dynamics, or macroeconomic factors can affect its risk profile. If such changes occur and the historical beta does not reflect the new risk environment, adjustments may be needed. For instance, if a company introduces a disruptive product, undergoes a major acquisition or divestiture, or faces regulatory changes, these factors can impact its future risk and require a reassessment of beta. Structural changes within an industry or sector. Industries or sectors may experience structural shifts that affect the risk characteristics of companies within them. These shifts can arise from technological advancements, changes in consumer preferences, or regulatory developments. Adjusting beta to account for these structural changes can provide a more accurate assessment of the investment's risk exposure. Event-driven factors. Certain events, such as earnings announcements, mergers and acquisitions, legal disputes, or regulatory actions, can introduce short-term volatility or idiosyncratic risk that is not fully captured by beta. Adjustments may be necessary to account for these event-driven factors and provide a more comprehensive risk assessment. Portfolio considerations. When constructing a portfolio, beta adjustments can help align the overall risk exposure with the investor's risk tolerance and desired asset allocation. Adjusting beta for individual investments within the portfolio can ensure that the aggregate risk of the portfolio matches the intended risk level. This is particularly relevant when diversifying across different asset classes or investment styles. Alternative risk measures. In some cases, beta alone may not adequately capture the risk of an investment. Adjustments may be necessary to incorporate additional risk measures, such as factor models, volatility measures, or stress testing, to provide a more comprehensive view of the investment's risk profile. It's important to note that beta adjustments require careful analysis and consideration of relevant factors. Adjustments should be based on sound judgment, thorough research, and a clear understanding of the specific circumstances affecting the investment's risk profile. Consulting with financial professionals or utilizing sophisticated risk management tools can help facilitate accurate beta adjustments in these situations. Factors such as leverage and non-systematic risk can indeed impact beta values. Here's how they can influence beta. Leverage. Leverage refers to the use of borrowed funds to increase an investment's potential returns. When a company or investment employs leverage, it can amplify both its gains and losses. As a result, the beta of a leveraged investment is often higher than that of an unleveraged investment in the same asset class. This is because leverage increases the investment sensitivity to market movements, leading to a higher beta value. Therefore, when assessing the risk of leveraged investments, it is important to consider their adjusted beta values to account for the impact of leverage. Non-systematic risk. Non-systematic risk, also known as idiosyncratic risk, is specific to an individual company or investment and is unrelated to overall market movements. Non-systematic risk can arise from factors such as company-specific events, management decisions, competitive dynamics, or industry-specific risks. Since beta measures systematic risk, it does not capture non-systematic risk. Therefore, beta alone may not fully reflect the total risk of an investment. Investors should consider non-systematic risk separately and evaluate it using other risk measures, such as standard deviation or specific risk measures. Non-systematic risk can lead to divergences between the actual returns of an investment and the returns predicted by its beta. This divergence is captured by the concept of alpha, which represents the excess return of an investment above or below its beta-adjusted expected return. Positive alpha indicates that the investment has outperformed its expected return based on beta, suggesting that the investment manager has generated value through skill or other factors. It's worth noting that leveraging an investment can increase both systematic and non-systematic risk. Leverage magnifies the impact of both market movements and company-specific events, potentially increasing the volatility and risk of the investment beyond what is indicated by its beta. When analyzing beta values, it is important to consider the presence of leverage and the potential influence of non-systematic risk. These factors can impact an investment's risk profile and should be taken into account when evaluating its suitability and potential performance.